Well, good afternoon, everyone. And for those of you who declined on the cricket to watch this panel, thank you very much. This is the panel on mine finance, creating value and scale, understanding alternative finance sources beyond the public markets. My name is Stuart Olley. I'm a partner with the international law firm Gowling WLG. I'm based in our Calgary, Canada office, so I'm certainly very happy to be here in beautiful Cape Town. In my hometown right now, it's minus 20 and snowing. I'm head of our Canadian Natural Resources Group, which for us encompasses both mining and oil and gas. And I've been very lucky over my career to work with junior companies in both sectors, as well as investment banks, off-takers, and private equity. So I'm particularly interested in today's panel because the recurring complaint I hear from my clients these days is the lack of available capital for their industries in the resource sector. So understanding where there are alternative sources, of course, is critical to all of us. So on our panel today, we're very fortunate to have Stefan Eitel, who is a director at the metals and mining team of KfW IPEX Bank. Stefan holds both a German and US master's degree in economics and started his career in the export and project finance unit of KfW. After 3 years, he joined the German Federal Ministry of Finance, supervising their mandate for the German Export Credit Agency system. After returning to KfW and working for the bank's treasury for 4 years, he returned to export and project finance, took over as head of portfolio management for the bank's basic industries portfolio, and since 2008 has headed the metals and mining team of the bank, being responsible for acquisition and structuring of new transactions. Cathy Nader, who is a chemical engineer and a CFA charter holder, who has worked in investment banking for the last 18 years. Cathy's experience covers structured products and derivatives, as well as structured debt finance. Cathy joined Nedbank in mining and resources team in 2007 and has extensive experience in structured commodity hedging and in debt financing various mining companies and projects across the African continent. Nick Farr-Jones, you can just wave, is a specialist in resource investment and corporate governance. Originally a commercial lawyer, he has spent the last 10 years as a managing director and head of commodities and mining finance at SocGen in Australia, before joining Taurus in April 2009. Nick is also an experienced public company director, so can bring both perspectives for the panel today. Donally is managing director at Denham Capital, a global private equity firm with more than $9 billion under management. She has over 20 years of experience in the mining sector, originating, analyzing, structuring, and executing investments across the globe in a variety of commodities. Since joining Denham's mining team in 2011, she's been responsible for new equity and debt investments and managing ongoing investments in various stages of their life cycles across North and South America and Africa in commodities including copper, zinc, silver, lead, niobium, tin, and rare earth elements. She was also responsible for originating, monitoring, and exiting the investment in JDS Silver that was successfully sold to Coeur Mining in 2017. She sits on the board of directors of Santiago Metals, Stellar Mining, and Mining Ventures Brazil. And prior to joining Denim, Carolyn spent over a decade providing cross-border finance to junior mining companies across Africa at Investec Bank and Rand Merchant Bank based in Johannesburg. She's a chartered accountant and was recognized as one of the 100 global inspirational women in mining in 2013 and 2015. And finally, Terblanche is a specialist in the mining sector with experience in business and corporate development, acquired in investment banking and experience in the main global mining financial markets, with a history of important transactions involving sponsors and assets in mining financial centers, both in developed and emerging markets worldwide. He began his career in South Africa with Glencore, a predecessor of Billiton PLC, and moved to the United Kingdom in a role focused on business development and mergers and acquisitions. Tice moved to investment banking, and after 8 years with Standard Bank London, he left as chief of mining and moved to Toronto to join CIBC World Markets in their investment banking team, and then moved towards a more technical role and is currently vice president of business development for Ausenco. So I thought we might start today by asking each of our panelists to tell us a bit about their company and what role they play in providing alternative financing in the mining sector. So perhaps we can start and just work down the panel. Sorry, can we just check the mics?
Hello.
Anyone?
Hello.
Is that clearer? Thanks. Thank you, Stuart. So Nedbank is one of the big four banks in South Africa, and we are headquartered in Johannesburg. We broadly split into three different clusters, which is the corporate and investment bank, our retail and business banking cluster, and wealth management. Within the corporate and investment bank, we have three broad areas, which is lending, advisory, and global markets. Our lending business is a sector-focused business, and I sit in the mining team within the lending business. Because we are sector-focused, we provide all types of debt finance to mining companies, right from project finance all the way through to corporate facilities and acquisition-type finance. Our debt team, we've got a lot of people in our debt team, roughly 15, 16 people. We have very strong technical expertise. We have metallurgists, engineers, geologists, lawyers, and accountants. And on average, over the last 5 years, we've closed over 20 financings per year for the last 5 years. From a project finance perspective, our average ticket size is between 20 and 50 million US dollars, and we can go up to 150 million US dollars, for the right type of credit quality. Our mandate in Cape Town here at the moment is to look for good quality bankable financing opportunities across the African continent.
Thank you. Carol?
Great. Hi, everybody. That's better. So you heard a bit about Denim from Stuart, and thank you for that intro. We're a global private equity fund. I am solely involved in mining, even though at Denim we also do oil and gas and power and renewables. Our mining investments roughly total about $2 billion, and that's about a third across North and South America, 1/3 in Africa, and the rest in Australia. We look for later stage projects where our capital can be used to progress the project through to a construction decision and then into production. Ideally we'd like the unicorn of a fully bankable feasibility study, a great team lined up, permitting all done, great jurisdiction, but those things don't come along every day. So we'll get involved where there's been substantial de-risking done on the assets. And we look for projects where between ourselves and the debt providers, we can fully fund the projects. So we see a lot of projects out there which have just stalled because they can't get any funding. And our entire model revolves around making sure projects are fully funded before we start spending the first dollar. We are predominantly an equity provider. We will, in certain very limited circumstances, do debt, but 95% of our business is equity.
Yeah, thanks. Good afternoon. KfW is a bit of a... It worked perfectly with you, so it should me well. So KfW is a bit of a special animal in the banking world. KfW as a group, first of all, is a state-owned development bank, the development bank of the Federal Republic of Germany. We, as KfW IPEX, IPEX stands for International Project and Export Finance. We are 100% affiliate, a legally separate entity from KfW. Unlike our mother company, we are a commercial bank, so we act like other commercial banks, like Netbank. Nevertheless, being part of a more politically driven banking group, we do carry a mandate, so we can't look at each and any project. The projects we are looking at and trying to finance, they need to have any European link. Doesn't need to be German, so European link. And in mining, that means these are either projects where European equipment goes into processing plants, mining fleet, and things like that, or maybe more important, transactions where offtake streams go into Germany and Europe. Otherwise, as other banks as well, we are limited to debt. Even if we would like to do equity and other things, just from a regulatory point of view, that it's simply made close to impossible. So it's that, but we have a global footprint. We are on all continents, basically looking at all raw materials which are essential for the European industry. We are open to project finance, corporate finance, junior miners, mid-tiers, majors, whatever it takes to mobilize interest for Europe, we are happy to look at.
Stuart, Taurus We hung our shingle about 12 years ago. We first raised a couple of equity funds, managing about 600 million US dollars. We found our LPs, our investors, were a bit concerned about the volatility of the equity markets at the time, and a bunch of us have banking backgrounds, predominantly my old boss, Mike Price from Societe Generale, so three of his underlings sort of joined, but the principals came out of ABN AMRO, which was taken over Bank of Scotland in Sydney, I think around about 2003-4. And so a bunch of us have banking backgrounds, as with my panellists colleagues here, about 50% of our guys have got technical backgrounds, so metallurgists, engineers, geologists, and the balance of us have finance backgrounds. 2013-14, we started a market for a debt fund. We raised $1 billion. That's fully committed and deployed. We're halfway through raising a second debt fund, targeting about $1 billion plus. Very quickly, a third, maybe a bit more, 40% of our exposure would be in Africa, a lot of West African gold. We've done some reasonable transactions. We can underwrite 20% of fund size. So, you know, we've done, I think, three $200 million transactions. We have 12 months just, or a bit more than that, but to sell down to a 10% final hold, but that's not the borrower's risk. So precious metals has been a focus. We like base metals, metallurgical coal. We've got a fair bit of exposure to that in Queensland. Mineral sands, we've done industrial minerals, so mineral sands in WA, and recently potash. So we're based in Australia mainly. Sydney's head office. We've got a reasonable office in Perth. We've got one originator, Hubert, in Europe. So far so good, but we do have, you know, one or two things that keep the lights on at night. But that's us.
So Ausenco has been around for just over 25 years now. We're a global consulting, engineering, project delivery and operations business. We've got consulting business lines that cover the full life cycle of a project, from mining consulting, environmental on the one end, all the way through to engineering, all the various study phases, and then design and execution, both on an EPC or a EPCM basis. And then we've got operations and maintenance group, where we will contract operate process plants on behalf of our clients. We can also execute on closure plans, so the entire full life cycle. We have got 26 offices in 14 countries around the world, all the way from APEC Africa and Southeast Asia, and then a number of offices in South and North America. We've been active in Africa just about since year one. We've executed more than 65 projects, studies and projects on the African continent. One of our most successful fixed price EPC contracts was for Equinox building Lumwana in Zambia in the early days, obviously now owned by Barrick. We built phase one at Tasiast for Kinross, obviously coming out of Redback. We've been involved in mineral sands for Kwale in Malawi. We built Sabodala for mineral deposits. We built Kinsevere in the DRC, so a very, very broad experience and track record. And obviously, as opposed to some of my esteemed panel colleagues who compete at times to provide capital and sometimes do team up, we actually sit in that mix of our clients needs capital in whatever form it comes, and we need our clients to be able to raise that capital to actually bring the project to reality and being able to deliver that project. And in particular, we are very confident and capable in our fixed price EPC execution of the projects we're involved in, which of course drive a very different outcome for shareholders, and it manages the risk in a very different way for those who are providing the capital. We take the price, the performance, and the schedule risk onto our balance sheet. We're a private company now. We're majority owned by resource capital funds. So we've got that capability to take that risk on our balance sheet, which fundamentally changes the risk profile for existing shareholders and the risk profile for the additional equity and debt providers. And that's where a very valuable piece in the very complex puzzle.
Thank you. Before we start, Cathy, perhaps you could tell us a little bit about what is the role for conventional debt for miners in today's market, and what sort of returns are you looking for, and how has the lending environment sort of evolved in your time doing conventional lending?
So Stuart, commercial banks continue to play a big role in the funding space in the mining sector, we still remain the cheapest form of funding available to mines when compared to equity or alternative finance solutions. And I think there's a very good reason why we are the cheapest. We certainly do not take on the same levels of risk as some of the alternative financiers do in terms of gearing and covenant structures. And we are less nimble than the alternative financiers, and that's primarily due to the regulatory environment that we work in. For example, the anti-money laundering legislation we have to work with. Because of this lower risk, we take our returns are lower. They're usually capped returns with no, equity upside or any other requirements that you might find in an alternative financing structure. We also see our role in financing going beyond the project finance stage. We typically have long-standing relationships with our clients as they move up the development curve and into production. We can then provide working capital facilities and hedging lines. And these do actually become more complicated to provide if there is an alternative funding structure or funder in the structure who is holding the security.
Excellent. Well, perhaps Nick,
Be closer. Hold it a bit closer.
Okay.
you could comment then, as a provider of alternatives traditional debt financing, do you see yourselves in competition with traditional lenders, or do you see that there's a role for alternative finance and traditional lenders to work together?
I think, to be honest, it is a competition, for terms and, the risk you're prepared to take and, from a project perspective and a company perspective. As I said, we can underwrite 20% of fund size. It means we have to syndicate over a period of time, and so then we work closely with banks and what have you that have got interest in the project. I hear what Cathy says, that maybe the alternative financiers do take a little bit more risk, and I can assure you that our due diligence is pretty full, but I do understand that we're prepared to do some bridging finance, particularly if the company doesn't feel that their market cap, and this is most companies, reflect the quality of their project. So as opposed to going out and raising equity, if we're confident that it's not a bridge to nowhere, that there will be a project in due course and based on all the study work, then we're happy to do a bridge, and we've done a number of them that typically would be tied to a project financing. So we agree terms up front. We agree what the project financing terms will be, and we're happy to do that, and it might be a 6-12 month bridge before CPs are met to draw down of the project finance facility. But at the same time, I was privileged to have 14 years with SocGen, took a young family to Paris for 4 years. I've still got a great connection with the bank, and I appreciate the role that banks play. And so we all have a role to play in the sector that we're down here in Cape Town for, the mining sector, which I've loved for 25 years. I've been in that now. I feel very privileged to have been in this sector because I think it's 2 degrees of separation in mining. And this is a fantastic conference because we come from all around the globe, and it's almost like a rugby tour again. The people you get to meet, the friendships you make, bumping into people from all around the globe is just wonderful. And so, I've got great respect for what the bankers do, but we're out there competing as hard as we can. One thing we don't require is hedging. As a banker, I understand the need to do risk management, and I'm all supportive of companies that do want to, particularly when you've got a big capital spend, to lock away some price protection. We just say to our potential client, look, we don't require hedging, but if you want to, go and tap on the door of one of the banks and we'll share security pari passu. More than happy to do that.
Excellent. Well, Carolyn, we've heard that Nick feels he's in competition with traditional banking as a provider of primarily equity. How do you feel, Denham works together with traditional financing or alternative financing? Or do you feel that you're in competition with both of them?
Thank you. So it's pretty rare that we'll do any form of debt. If we get involved with a company that already has shareholders and we land up typically as a majority shareholder, if they're minorities who are expecting debt, then we may do some debt. That is a very rare situation and only one that we've actually come across once. So more often than not, we are providing equity. It's not in competition to what Taurus does, or KW, or Nedbank. I would say that some of the other funds out there do some form of equity, so sometimes there's some competition. But more often than not, we're assessing debt providers for debt for our projects where we're providing equity.
Sorry, can we get these mics sorted?
Let me try that one.
Can we just find one that works and we'll pass it around?
From a selection perspective, I'd love to say we find the cheapest offer out there, but most of you will know the phrase goedkoop is dierkoop. So we tend to look for groups who can execute, who we know can get the deal done, where the risk that they're taking is appropriate for the reward that they're making. And sometimes that might be bank finance because it's longer tenor and cheaper, and sometimes, depending on the commodity, it might be an alternative finance provider. It's really sort of horses for courses in our case.
Excellent.
If I may add on this, even you didn't ask me, I tend to disagree that there is competition between banks and I call it non-banks. Maybe it's my very own definition of competition. Competition for me requires a level playing field, which it isn't. It's simply because there's regulated money against unregulated money. Both has its rectification, no doubt about it. But we discussed it for a while in the bank. Can we compete with these banks, near banks? No, we can't. Due to our regulatory process, any bank has. In certain instances, due diligence process and all the requirements you have to do.
When you say regulatory process, what are you referring to in particular?
Banking regulation. Banking, simple bank regulation.
Okay, so you're talking about credit committees and...
Yes. That's one of the...
Well, we, of course, have a credit committee process. I mean, we don't want to get out there and make a whole bunch of bad loans because we'll be out of business. We won't keep the lights on.
The point is, and Cathy may confirm that, it takes a hell lot of time in a bank to get to it. You can do that in a week or two.
But
we can't.
That's your problem.
Correct. I'm only saying, but both has its rectification. And in terms of speed, we will never be able to compete. It's a different world. So,
but that is, the French. I worked for SocGen for 14 years. The French, made the word bureaucracy.
It is.
That's a French word, and you've got to sort that out within your system.
Sure. No, absolutely. But at over the last 12, 18, 24 months, we started collaborating. We did a number of deals where both were in and everybody's happy. It was, in the first or two instances, was quite fun, in particular for the lawyers, to sort out the intercreditor issues. It was a feast for them. But now we have a few templates, boilerplates for future transactions, and that's a game where everybody finds its place and everybody's happy, and the project gets the various access to the various buckets with the advantages and disadvantages. And in the meantime, I see that very positive and very relaxed. There's room for all of us, and so. Competition, non-competition. Again, there's room for all of us.
Just one other comment there. And I'm not sort of blowing the Taurus trumpet because we have our own issues, okay. But one thing I try and say to a potential client is that having worked for a bank is that if things go wrong, and we all know that in the mining industry things go wrong. There's a million things, headwinds that can come against you. We obviously don't put someone into a workout committee. Whereas banks can do that. What we do, because if we don't do it, we don't keep the lights on, is we will work as hard as we can to restructure the facility, do whatever we can to support the client. Whereas having worked for a bank, and again, I've just told you that I was privileged to work for a bank for 14 years, you have this regulatory structure that if ratios and covenants aren't met, that then all of a sudden your client is in some sort of process that is not that pleasant.
Well, it feels like one thing where all the providers of financing are aligned is the much more rigor that goes into the due diligence process, doesn't it? And particularly the way that you dig into the technicals. And I think you all mentioned you've got your own in-house technical teams, and that has changed in the banking industry quite a bit. They've always been there, but I think a lot of the disasters that we've seen on financing was really focused the mind on the need, whether you're coming from the debt side or the equity side, to really dig deep into the technicals, isn't it?
Tis, I was struck by one of the things that you said in the introductory remarks, that you provide fixed price EPC contracts. And in one of yesterday's presentations, there was a very interesting comment that they felt that cost overruns and delays in mining projects were one of the reasons it was difficult to raise equity financing, and that EPC providers had an important role in how they contracted to provide projects. So it's interesting. I mean, other than fixed price terms, are there other ways that you think EPCs can help junior miners?
Well, it addresses, as I said, some of the key risks in the three buckets of price, performance, and schedule. I think when you give if the owner gives the original spreadsheets to the banks, in particular in equity providers, and you start running downside scenarios, we know the industry, we've not done ourselves any favors over the last couple of decades on really poor execution. Cost overruns, no matter which data source you use, is anywhere between 40 and 60% seems to be the norm over the last couple of decades, sadly. So any provider of capital is going to run those kind of scenarios on the price side. Most of the delivery has been 6 months, 9 months, 12 months late, so you put that into the sensitivities, and process plants that don't run to nameplate capacity. So you put those three things into the scenarios, and all of a sudden the debt, a lot of those ratios that Nick referred to will get broken at fairly modest movements in commodity prices, for example. So all of a sudden you see a very significant impact on the debt capacity and potentially the cost of debt, and the same with the equity capacity. So the ability for a provider of fixed price EPC who takes that risk of schedule, guarantees the schedule, guarantees the ramp up, and there's performance tests and there's financial guarantees that sit behind that, and obviously the price is a fixed price. Not all of a sudden, but ultimately you deal with those three elements of risk. And it really is, the risk doesn't go away. We all know mining projects are very risky by its pure nature. So it's not as if the risk goes away. You're just putting the risk in the bucket and putting it with people who are best equipped to deal with that risk. We all know there's lots of management teams out there that don't necessarily in-house have the required project delivery and execution experience. We know it's a very thin gene pool out there to try and find these people. So rather than that risk sitting on the side of the owner, a more logical place that ultimately is going to drive a better shareholder value outcome could be for that risk to actually sit with professionals who know how to manage that risk better and who is capable of managing that risk.
Excellent.
Stuart, if I may, I'd like to respond to Nick's commentary around the workout teams within a bank. And I think that's very dependent on the bank that you've partnered with and the strength of that mining team. I know at Nedbank we do a lot of the work with our clients if there's waiver requests for covenant breaches, any sort of restructuring. In the 15 years that I've been in the team, only one of our clients has gone to the workout team, and that was when they put themselves into voluntary administration. So I think it just talks to picking the right funding partner, whether it's a bank, an alternative financier, equity, etc.
So that's an interesting point. When you look at lending, whether it's conventional financing or unconventional financing, what levels of control do you look for in the investment companies? Do you typically put a director on? Do you look at having an advisory committee? Do you rely on public reporting? Do you ask for more frequent reporting? And this is one of the areas that I find in the oil and gas sector and the clients that I've worked for, they feel that there are sometimes very onerous terms put on them.
Just quickly from our perspective, you've obviously got your facility documentation, which governs your covenants, your ratios, etc. You obviously get monthly at least updates when a project's being built, and then often during commissioning and early months of production, monthly reporting. We, of course, when we were doing equity, yes, we would take board seats, but of course it's when you're a debt provider, no you don't, that's a conflict. Because it can, sadly, as we know in the mining sector and every sector, debt can be anti-equity when things don't go well. So, of course, you don't take a board seat in relation to being a debt provider. But hopefully you've got, as we've all spoken about, the relationship, the trust that you have with your client is always critical, and you expect that, you know, your client honours the reporting requirements that you have, and if things do go pear-shaped for whatever reason, then hopefully you sit down and you work out a solution going forward. And you know, you've got to be flexible in a lot of times. One thing, Stuart, I didn't add is in our second debt fund we can do equity, but it's got to be linked to the provision of the debt, and whether it's to maybe win the deal or we think it's a great opportunity to go for the equity ride. Yeah, but that's from our perspective.
You know, I think for us, he who brings the gold makes the rules. So, you know, we bring the money, like we decide what sort of control we want, what reporting we want, what we want to see. And, you know, that might sound terrifying when you think about the junior markets with these amorphous bodies of shareholders, but we are typically controlling shareholders. We want a more than 50% stake, so not a 19.9 for those of you that are used to the Toronto markets. Like, we want a proper controlling stake, and we control the board, and we control the purse strings. So, you know, if like you think that some of the bank's terms are onerous, you should try dealing with some of the equity providers.
Fair enough. Stefan, when you look at putting project finance in place, and you look at either taking out, you know, traditional debt or non-traditional debt, you know, how do you find that experience? Do you have a preference for what the company has put in place? Do you find it more difficult one way or the other?
Well, in project finance, so greenfield, SPV, I mean, banks only come in at feasibility stage anyway, and that's kind of the dividing line between two worlds for the company anyway. There's a world prior to construction and operation and after, and that kind of is mirrored in the balance sheet. So to be a little provocative, I don't care at all what was before, because we're going to enter in a new world anyway. So it was either traditional or non-traditional, and of course you have to see what the former structure, whether there are implications for the future, of course. But yeah, in project finance, you're entering a new world anyway.
And I think what typically happens is by the time you get to the point where the project finance banks are coming in, anything which has gone in before then, frankly, is equity. You can call it whatever you want. You know, you can name it structured finance, you can name it debt, you can call it whatever you want. The risk is an equity risk. But, you know, there's no two ways about it as far as I'm concerned.
Yeah, the challenge that I've seen with some junior clients is where they do, for example, early stream deals or early offtake deals, and there's security put over the company or over the asset. And then they come to do project finance, and it's a bit of pushing and shoving around who's going to get priority, who's going to be subordinated. And so I find that's an area that, you know, sometimes junior companies are so desperate to take the money, they don't think about what's the consequence of the security I'm offering now.
That's a good point, but that goes back to what I mentioned before when it comes to negotiating intercreditor agreements with streams. Doesn't matter whether they're already there or they come in at the same time. That's a challenge, yes. Because if you look at it, a stream is, to me, that's neither debt nor equity. That's something new. Yeah. Maybe it takes a university professor to come up with a name. I mean, we all learned in university there's debt and equity and nothing else. That's maybe something new and maybe just particular to mining. So we're going to need to go through that exercise anyway, whether it has been there or just comes in later. But I agree, there are a few instances around where they too early embarked on these kind of instruments and without thinking of the consequences a year or 2 or 3 years later on.
Okay.
And that doesn't just impact the debt. You know, if a project comes to us and there's KfW debt or Nedbank debt and Taurus have provided some mezz and somebody else has got a stream, by the time the money trickles down to the equity, there's so little left that it's not worth it for us. So, I would say to, companies raising finance at any stage before you get to a feasibility study, like, think carefully about the longevity of what you're putting in place and how that's going to impact whatever structure you might do in the future. Because you do need to leave some money back for the equity people who, frankly, are in theory taking all the risk.
And as a debt provider now, I totally agree with that.
So let's change gears quickly. We've got a little bit of time left. One of the things that I've found remarkable is the spectacular fall of coal. And I saw that quite recently, a number of funds now have said that they simply will not provide investment for companies that have more than 25% of coal in their production. What sort of risks do you worry about in your investments? Do you see other areas where we might see that sort of rapid change in favorability of commodities?
If I could just maybe kick this off very quickly. We now, when we raised our first debt fund, in our equity fund, we were in thermal coal in the Hunter Valley of New South Wales, about 2 hours north of Sydney. But just the LPs, the investors that we have in our debt funds, they're all US institutions. They want to rule out thermal coal, generally speaking, a lot of them, endowments and uranium. And so it's just a lot easier, even though I'm a true believer in coal-fired power generation, particularly when you come to a country like this and you see the issues, and I see the price rises in my country of Australia, and I see ageing people in my country not putting on air conditioners in summer and not putting on heaters in winter, and it pisses me off. The price rises that I've seen in my country because we don't have reliable, cheap coal-fired power. And so I'm a huge believer, and I don't care if the Chinese come down and build them, and I've been down to see our former resources minister who just resigned, Matt Canavan, in Canberra, about that, and we're happy to do that. But from a Taurus perspective, we've just said it's too easy. It's too hard to put thermal coal in the bucket. So we've ruled out thermal coal and uranium. Sadly, as I said at the beginning, we've done a fair bit of met coal, and that's probably about 20% of our total exposure. But I'm into look at the urbanisation of India and China, and the millions and millions of people have been sort of dragged out of poverty. You need power to do that. You need cheap and reliable power. And so whilst we all get caught up in the climate change issues and thermal coal and fossil fuels, to me it's a personal thing about the well-being of people and the livelihood of people and the affordability of lifestyle.
Absolutely, Nick. From a Nedbank perspective, we in South Africa, we need to keep the lights on in South Africa. We've made a decision. We split thermal coal into coal-fired power stations. We do not fund those. We do, however, continue to fund coal mining, and we do continue to support our existing coal clients.
I think for us at Denham, we have a very large metallurgical coal position in the Bowen Basin in Australia. And we have just found with our mostly US investors, again, endowments, foundations, state pension plans, those sorts of groups, it's just too difficult. It's just way too difficult. Mm-hmm. So I think it's unlikely that we would be doing any more met coal going forward, because you can't tweet met coal is used in steel making. It's too long. Nobody cares. They all think it's coal and it's all bad. My personal opinion, so not a Denim opinion, but a personal opinion, is there'll come a stage when reality actually impacts, and people will turn around and go, oh, you mean we don't have a warm dormitory room in our university dorm room because you've turned off the power and now it's cold in the middle of winter? Like, yes, that could be an impact. And I think when reality finally sets in and people get over the sort of almost mass hysteria that there is around coal and fossil fuels, then I'm hopeful that things will return to normal. Again, my personal opinion, not a Denim opinion.
All I can say, Carolyn, is coming from Calgary, I only hope that reality sets in quickly. So very quickly, maybe I'll just ask the panel, any favorite jurisdictions? Where do you like? Any no-fly zones?
from our perspective, we'll go wherever our clients and the projects are. As long as our only test is whether executive management is comfortable enough going to the country, then we'll send our people there. And if the equity and debt will fund, then we'll build it anywhere.
I mean, our backyard is always, the best because it's easy to do the due diligence, stay in touch with the people. So our backyard, of course, is Australia, but we go everywhere. I mean, there's a few jurisdictions that are off limits. I mean, anything getting to withstand. There's probably 15 countries. But we, as I said, we can do 50% of our commitments in non-investment grade countries, and that's mining.
Stuart, from a Nedbank perspective, we have a mandate to lend across the African continent. We do have a no-go list, which is updated quarterly by our group economic unit, and that does change from time to time. But, for example, countries that continually stay on that list would be the likes of Somalia, Sudan, South Sudan, countries like that.
Great. In terms of formal no-go list, we have probably the same for you as you, that 4 or 5 names, but no-go doesn't mean go. They're easier and not so easy jurisdictions, and there's a large. It's not black and white. There's a lot of grey, some 50 shades of grey, some grayer, some less. Particularly Africa, I have to say, particularly from a European perspective, is not an easy continent to deal with. It's for you much easier, as you're here. But yeah, we try, specifically in mining. I mean, the ore bodies are where they are, and you need to deal with them where they are.
Excellent. Carolyn, last words?
Yes, for us it's a question of risk versus return. So what type of risk are we taking for the return that we're hoping for? And tied into that, it's can we find a management team which has executed in that country and been successful before? So those 3 things all tied in would determine whether we'd go somewhere or not.
Excellent. Well, I see by the large clock on the wall that our time is up. Please join me in thanking our panel. I thought it was an excellent discussion. I really appreciate the time today.